All right. Good morning. Good afternoon to a few of you. Welcome to the community briefing. My name is Gregory Sneed, and we are glad you're here. Our guest today is Alan Perry, and he's going to be sharing some wonderful information about the housing and mortgage industry. So that is something near and dear to most of our hearts. So we're glad that you are here. Today is da, 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 May the 4th be with you. Today, we're joining us, and yes, it is May the 4th, so May the 4th be with you. My name is Gregory Sneed. The name of my company is Lifesaver Financial Services, where I help my clients keep more of the money they make, and I do that through financial services, financial coaching, and financial literacy training, because I firmly believe that when you feel better about your money, you feel better about your life. And now I'm going to shut this thing up and and bring to the stage our queen of the community briefing, Miss Crystal Mitchell.
Greg has such a great sense of humor. I just love Greg. Hello, Henry. How are you? Good to see you. I am Crystal Mitchell. I am the co-director of Recycling Black Dollars and the inspiration behind the community briefing. Thank you, Greg, for that intro to the May 4th. May is actually my favorite month of the year because it's actually my birthday month. So I am celebrating this whole month season as my birthday season. I kicked off the month May 1st. So I am celebrating that this whole entire month. So
It's
you
not a
guys will
birth.
get it.
It's not a birthday. It's a birth month.
Birth month. I was
Birth
born
month.
on the birthday, so I
Okay,
get to
right? One day
celebrate
is
the
not
whole
enough. You got
month.
to have, and you get 31, right?
At 31 days, I get to celebrate. That's the joy of being born on the first day. So the inspiration was born out of the pandemic. Actually, I wanted to make sure that we had a resource that we could get information in the moment from those that were hearing and sitting at tables where decisions were being made about us and our community. So it then took on its own legs, and it has now become that source. And so we're very pleased, the team and I, about where the direction of this platform is going. So it is our platform, not just us, not the team, which is myself and Greg and Stephen and Robin Billups, Stephen Turner and Robin Billups. It's all of our platform. It is powered by Recycling Black Dollars and the BBA. I'm all about collaboration, guys. If y'all haven't figured that out, I'm going to force us Black folks to work together if it kills me and y'all. But we going to work together. And it is about us making sure we support one another and that we could gather around and make sure we're supporting our community to build us up. It's so important that we do that. So we bring our leaders and our stakeholders here to this platform, and they share important information that is applicable to us in our community. We are financially supported by the Los Angeles LDC. We're also supported by Southern California Edison, PCR, Pacific Coast Regional Center, and Wells Fargo Bank. And there's also SoCal Gas right behind me as well. So we welcome all donations. We are so appreciative of our sponsors, and we thank you guys. And then this incredible group of people that come to us every week. We thank you guys for showing up and continue to share us. You can go over to our YouTube channel and hit that subscribe button so that you get notification every time we upload a video there. We want this platform be the premier place that you come to get information about what's going on. So today we have Mr. Alan Perry. We're going to talk about housing and real estate and investment, because that is the pathway to wealth, generational wealth. And so we're going to talk about that. That's a really important topic when we talk about Black folks and generational wealth, is how do we get into this space? At the end, Stephen is going to talk about a symposium that we're having on May 18th, which is a concentrated conversation about the Crenshaw corridor and what's happening, what has happened, and what's going to happen in the future. So I want to welcome all of our faces, Henry and Kevin. I haven't seen you before, Kevin, but hello. And we have Teresa, and then we have our regulars, Mr. Armand and Ted and Yeshiva and Jonathan. Welcome all of you. Mr. Joseph Duncan. So thank you guys. With that, I'm going to kick that back over to Mr. Greg, and he's going to introduce our guests.
Yeah, I think going back to the beginning, I was brought in as a guest speaker for one time and came back a couple of times for talking about the PPP, and look what happened.
I know, because I'm hell bent on making us all collaborate. I'm just gonna make that happen.
Does that mean I don't want to give a presentation?
No, just don't do the second one.
It don't really matter. You come in anyway.
I came back and the PPP was so much going on. So I did one and that was fine. They came back and because the rules kept changing, if you remember back then, they were changing every day. So I'd give one presentation, it was a set of rules, and then all of a sudden they changed. Oh, you got to come back and do an update. So I think after 3 or 4 of them, it was like flypaper. It just stuck. So,
and if anybody knows me, and there's a couple of people here that know me pretty well, Armand, once you get caught up in my web, man, you don't get to leave.
It's a trap. It's a trap.
You do not get to leave. You get to stay with me forever.
That's why I said flypaper, but yes, this is spider paper, same thing, you know, in the web, right? In the web.
It's a web, and you get to stay.
Not the World Wide Web, it was the spider web. All right. Occasionally, we have some guests on here that they're fairly junior. They've had 1 or 2 things that they've done, and we do an intro, and it's pretty quick, and they get into it. Today's not one of them days, okay? The gentleman we're about to bring on to the virtual stage, Mr. Alan Perry, has been in the game for a little more than a bit. And so bear with me as I kind of cover some, not all, but some of the things that he's done. But first of all, let's talk about it. Alan Perry. You had a middle initial?
D for
D,
Dunbar.
Okay. For who?
Dunbar. Paul
Dunbar.
Lawrence.
Okay. Alan D. Perry is a mortgage broker, and he has extensive senior management experience gained through developing and managing hundreds of $1 million in real estate loans and related transactions. He served as a correspondent to a $90 billion banking institution, held ultimate responsibility for the origination, servicing, and administration of residential and commercial loans. He has overseen all forms of loan review, due diligence, and controlled asset management, thoroughly conversant with trends and conditions in today's financial and real estate markets and the requirements of attaining optimal levels of performance and profitability. He's got over 20 years of successful experience, augmenting by an MBA from UCLA and an undergraduate degree from Stanford University. So he has been with Alton Lending Mortgage as a mortgage broker since October of 2007. So he's still a bit of a rookie, right? 15, almost 16 years there. Homefield Financial Loan Funding Corporation of America, Loan Depot Express, Pacific Shore Funding, Perry and Allen Mortgage Advisors, Quality Asset Services. Let's see, Columbia Savings and Loan Association. Oh, savings and loans. Those are kind of in the past, right? The S&L industry. American Real Estate Group. As I said, he has UCLA Anderson School of Management, an MBA. He went to Stanford University of Human Biology. And I'm imagining he is a resident or born and raised here in the LA area because he went to Dorsey High School. So it's my pleasure and our pleasure to welcome to the virtual stage Mr. Alan D. Perry.
Well, thank you for that introduction, and community briefing team, thank you for the invitation. I feel I almost have to look over my shoulder to figure out who Greg was really introducing. I would like to do a special shout out to my Anderson alumni friends, and that would be Jonathan Wilson, Stephen Turner, and Henry Brandon. Okay, shout out for the Bruins. What I'd like to do in the interest of time is kind of do a brief overview of the mortgage loan process, because that's where I think a lot of us get hung up in the home buying game. I think the real estate aspect is pretty straightforward, but when I get a lot of customers, particularly customers from our community that may have been denied at other institutions and whatnot, I find that their loans are very easy to get done, and it's just kind of a miscommunication or a misunderstanding of the process. So I'm going to kind of go through that process very quickly, and we'll save time for Teresa to talk about HUD and how HUD will be adding to the homeownership opportunities as well. So starting off, I'd like to kind of go over with this screenshot. Yeah, thank you, Greg. Is the 4 C's of mortgage underwriting: capacity, credit, cash, and collateral. Next slide, please. So capacity is just basically analyzing your income and looking at your debt as well as your new debt that would be a result of your mortgage to determine what you can afford. I mean, it's just simple math. And basically, there's 2 ratios that we look at. We look at what's called a housing ratio, which is just simply your total income less the carrying costs on the home that you're going to buy or the home that you're going to refinance. So that carrying cost would be the principal interest mortgage payment, the taxes, the insurance, and if you're in a homeowners association, the homeowners association dues, okay? And that, what we'll do there, that makes up, you divide that total cost by your income and you get what's called the housing ratio. Most cases, you'd like to see a housing ratio in that 38% range. But I got to tell you, you can go up to 50%, 55% in some cases, particularly with FHA financing and other sources of financing. The next ratio that we look at is your back end or your total debt to income ratio. And all that is, you just take the housing expense and you add your other bills. So your credit card debt, your installment debt, okay, any tax owed, any bills, period. You add that back to the housing expense ratio divided by your income, and you get your back end ratio. And a lot of times in the industry, or you may hear your loan person or your realtor talk about DTI, debt to income ratio. Really, it's the back end ratio that most folks care mostly about. On a conventional loan, a good ratio should be 45% or less. Again, FHA, we can go as high as 55%. VA, believe it or not, we funded loans at 80% back end ratio, because that's some of the underwriting benefits you have on a VA loan. Next slide, please. Okay, credit. Well, guess what? Credit is what credit is. Okay, the most important thing that we're looking at to determine your appropriate loan program would be your credit scores or your FICO scores. And what underwriters do, you have 3 scores. You have an Experian, a TransUnion, and an Equifax score. You always take the lowest middle score if you have 2 borrowers, or if there's 1 borrower, you take the middle score, period. All right. Now, what's considered good credit? Well, typically, any credit above 620, you can get a conventional loan. And then in about 40 to 50 point intervals over that number, up into the high 7s or the 8s, your higher your credit score lowers your rates. You might get a better rate as a reward for a higher score. All right. So as you see here in the data points being presented, 620 or below 620, you're really talking about looking at an FHA loan, or if you're a veteran, we can do a veteran loan, okay, a VA loan. Above 620, the world opens up in terms of conventional, FHA, VA, almost any loan product. And then it just grades up from there. So 620 to 660, 660 to 720, 720 and above. That just kind of classifies your score, clarifies your score, and means a better rate. Next slide.
And one quick question there. Does that also have a bearing on your rate?
Oh, that's exactly, that is what it has a bearing on. Your grade to score, whatever tranche you fall in, it will impact your rate. But in addition to the rate, it will impact your pricing on that rate. So say, for example, if a borrower has a 620 and right now par pricing, which means you're not buying that rate down, nor is anyone getting paid any extra credit for that rate, it's par, just like in golf, okay? Par pricing might be, say, a 6% rate for a 620. And that's par, where if you have a 720, that same 6%, you might end up getting a credit of a half a point or a full point, or better yet, you can go from a 6% to maybe 5.5, 5.25. So that's how your credit score is going to impact you. It's going to impact what you pay for the rate, and it's going to impact the rate itself. Okay. Cash. Critical elements of cash that you're looking at, it tells you what you can buy in terms of what type of down payment you're looking at. If you're looking at a standard conventional loan, you're talking about 10% down, 20% down. If you're looking at a VA loan, is 0% down. If you're looking at an FHA loan, we're looking at having to put down about 3.5% for an FHA financing. So one of the items that we're going to always look at is what are your cash? What cash do you have that can go toward down payment and closing costs? Because that's going to go back and impact the size of the loan as well as the size of the house that you can buy, or how we're going to have to structure the financing to make the financing work. In addition, if you're borderline in terms of qualifying, well, guess what? If you have excess reserves, say after you bought your house, you paid your closing costs, you've done your down payment, and you have 100 grand left in the bank. If you have, say, a loan that might be tough to get approved otherwise because of credit or income, well, if you look at reserves, if you have a high reserve amount, that will push the loan over the top and get you an approval. Okay. Or if you're buying an investment property, a lot of times you have to have maybe 6 months, 12 months of liquid assets, what's called reserves, to carry maybe, your principal and interest, title, insurance period over a 6 or 12 month span of time. So that's how the cash comes into the game: the down payment, the closing costs, your purchase capacity, and if your loan requires reserves, all that goes into effect as well. All right. Next slide. Collateral. Collateral is just simply the appraisal of your home. Now, in our community, we can do a whole different presentation on appraisals alone. We've heard and talked a lot about appraisal bias and what's going on in the industry in communities of color. But that's what an appraisal is all about. It's the collateral. You may agree to pay maybe $700,000 for a home, but if the house only appraises for, say, $650,000, $675,000, well, guess what? The loan is going to be based on the lower of the purchase price or the appraisal. Now, some of the things that you can do to help your home appraise for higher, or a seller can do to help their home appraise for higher, obviously is clean it up, fix it up, make it look as nice as possible. Because remember, a lot of the cosmetic elements of a home is not supposed to impact the appraisal, but appraiser is a human being. So if they walk into your house and it's cluttered, it's junky, it's messed up looking, it might be functional, it may not have any health and safety issues, but that human being, that mind is going to kick in and is going to downgrade the value versus if they walked into your home and it was pristine. So I always try to tell my customers, don't over worry about, how nice the home is necessarily, but think about it that you're having friends over for Thanksgiving dinner, you're having friends over for Christmas dinner. Okay, you want it to look as nice as you can. Now, why do we as lenders look so much on the appraisals? Because we're in the lending game. We're not lending money because we eventually want to foreclose on your home. So we always have to look at what our protection is. What's the collateral? How do we get repaid in the event we do have to foreclose on your home? Is there going to be sufficient equity in your house to get the loan paid off? Or what are we going to end up doing? Because we don't want to be stuck in the home business, in the real estate owning business, okay? So we've quickly covered the 4 C's. Next slide, please. So again, what do we look at? Strong income ratios, large down payments with strong reserves can offset any credit issues. So cash is king in that regard. Similarly, long and strong credit histories help your ratios, and good credit and income overcome lesser credit and down payment. We've had cases where borrowers may have 720, 750 credit scores, but they may only have 1 or 2 trade lines. And say if you're trying to do a jumbo loan, the lender might require 3 or 4 trade lines. So the quick fix, at least in our shop, is we tell you, hey, Stephen, go out and open up another couple of credit cards. Use them, pay the balances off. I just need to hit a credit level. Now, these are kind of the tricks of the trade that we know as independent mortgage bankers, but that loan officer at B of A or Chase or Wells Fargo may not have the knowledge, the experience, or the capacity to look at your credit report and tell you how can you improve it? How do you better your chance on getting a better loan? Okay. The third point, talk openly and freely with your loan officer. What I tell my customers is this: because we are an independent mortgage institution, I don't work for the bank. Okay. What you tell me stays with us. All right. So, if there are credit issues that aren't showing up on the credit report, talk to me about them. If there's difficulty in raising money, talk to me about them. If there's problems with your home, let's get that fixed first. Okay, I have a customer right now that has a home in Pasadena with some mold damage. Well, we're not going to send an appraiser out there until that mold damage gets fixed. So I'll tell a customer, pull your camera out, pull your cell phone out, rather, snap some pictures, send me a picture of your property, let me take a look at it, let's figure out what to do. So again, it's bet, and I know it goes against human nature, but you really want to be open and upfront with the person representing you on the financial side of your business, just like any other one of your financial professionals. You're going to always tell your tax preparer what's going on. You're going to tell your wealth manager what's going on. You got to tell your loan officer what's going on as well. Next slide, please. Yeah, up, back, backwards about 4 slides, I think. You want to go back to that programs page.
Yeah, I was trying to hit something on the chat and it hit this. So
Okay.
I want to hit from current line. Here we go here.
One more, that one with the gray boxes, down a couple. Yeah. Next slide. There you go. So different loan programs. Okay, your conventional loan is whenever you hear someone talk about a conventional loan or Freddie Mac, Fannie Mae loan, that's your plain vanilla loan where the borrower has 620 or above credit. The debt to income ratios are going to fall in that 45, 46, 47% range. You can do a 3% down, but typically it's going to be 10 or 20% down. Any down payment less than 20%, you're going to have what's called private mortgage insurance. And all that does, guys, is remember, on a conventional loan, the lender's exposure doesn't really want to be any more than 80% of the value of the property. What private mortgage insurance does, it insures whatever is above that 80%. So it allows you to do a conventional loan putting 3% down because 17% of the risk is going to be mitigated or insured by a private mortgage insurance company. So that's really the summation of a conventional loan. It's a Fannie Mae, Freddie Mac type of product, which really enhances the secondary market or the ability for these loans to trade across Wall Street, okay? Next category would be an FHA loan. And I'm pretty sure Teresa will probably talk a little bit more about FHA because FHA is the Federal Housing Authority. It is part of HUD, Department of Housing and Urban Development. What FHA loans allows you to do is it gives you a broader opportunity to buy a home. Lower down payment, remember 3.5%. Lower credit scores, so you can do manual underwriting down to a 500 FICO score. So remember, if you're below 620, don't think, oh my God, I can't buy a home. We can do manual underwriting on FHA loans down to a 500 credit score. We do it often, as a matter of fact, okay? Higher debt to income ratio. So instead of having to be in that 40, 45% range, you can be in the 50 to 55% range. So it gives a little bit more liberal underwriting standards. And the reason for that is because FHA will insure the loan. Okay, so again, the lender writes an FHA loan according to FHA guidelines. Should the loan go into default, they end up foreclosing, FHA will pay the lender off for the loan. So that's the big benefit and boost in FHA. VA, very similar to FHA, except for VA is 100% financing for veterans. Okay, both on refinances and on purchases. Now, FHA is an insured entity insuring the loan where VA actually guarantees the loan. So VA will just take the loan right off the lender's books should it go sideways and something happen to it. Jumbo financing. Jumbo financing basically just any loan above the county's loan limit establishment. So for example, I think in LA County, your maximum loan for conventional right now is like $987,300. So anything over whatever your county limit is would be considered a jumbo loan. All right. Very similar underwriting guidelines to conventional. There are some jumbo lenders that will go down to 3.5%, 5% loan to value or down payments, but most are going to require 15, 10, 15, or 20%. Guidelines are very similar, except for typically your back end ratio won't go over 45%. Now, some of these other programs, the bank statement loan, for example, these are great loans for self-employed borrowers. Say you own your business. So, I do my business, I get my taxes, I give my returns to Gregory to file my taxes. Well, we're going to minimize as much income as we can because I don't want to pay a lot of taxes, right? So the benefit of a bank statement loan is just that. You take a look at the customer's last 12 to 24 months, either personal statements or business statements, you average that, and that becomes their income. Now, there's a little bit of a rate hit, but most customers would rather go ahead and pay a little bit higher rate to get the loan than to truthfully and honestly say report their taxes and end up paying greater taxes over the course.
Is that
So
asset
that's a great program. And in addition to bank statement loans, they now have profit and loss statement loans. Okay, it's getting crazy again, where a self-employed borrower, their CPA or tax preparer will prepare a 2-year profit and loss statement, sign it. Whatever that income is reported, that's what gets used. Don't fall off your seat, Greg. Okay, but that's what's get used. For investor loans, we say no income. It's just like a commercial loan. It's called a debt service coverage ratio loan. You take a look at the property you're buying, say maybe you're going to buy a fourplex in Baldwin Hills or View Park. Well, we'll take a look at what will that cash flow, what is the renting for right now? And as part of the appraisal process, you'll get a rental survey. And whatever the rental survey or the current rents, the lower of the two says, as long as that covers the principal, interest, taxes, and insurance on the loan, so in other words, the covering of the property, you get the loan done. So we don't care at all if the borrower doesn't have to have a job. No source of income. The borrower's income isn't looked at all. It's just like a commercial real estate transaction. It's the property will cover the loan, okay? Other products, interest only. You know, that's not as popular anymore because rates, although they've gone up, there's no longer much of a difference, a spread between a principal and interest payment loan versus an interest-only payment loan. But interest only is just simply what it says. Your monthly payment is consisting of interest payments only, okay? Assets is income. You take a person, say, that has the Henry Brandon type of money, you take, fill off maybe $1 million of the money that he has in the bank, use that to calculate his income. Very simple. All you're doing is you're looking at what kind of return are the investments throwing off, and that's what's used to calculate your income. And then the final category will be down payment assistance. We'll talk more on the next couple of slides about that, but there's two primary programs out there. A lot of lenders have 100% financing where they'll do the first mortgage and then also do a second mortgage. So that's how you get to the 100%. But then also the California Housing Finance Agency, CalHFA, has down payment assistance programs that because rates and prices have gone up so much, that's becoming more popular as a financing vehicle as well. Next slide, please.
Quick question: that jumbo differentiation is set nationally or locally?
Jumbo loans really are traded. It's really a product of Wall Street. Okay, so jumbo lenders will establish their guidelines, but of course they're going to sit down with the Wall Street houses because all loans, no matter who does your loan, pretty much every loan is going to end up being sold 2 and 3 times. Okay. The benefit of a FHA, a VA, or a conventional is because FHA and VA are insured and guaranteed. Conventional are written by Fannie Mae guidelines, so they're well-established guidelines. Jumbo loans, just very similar to conventional, they're more standardized now, so they're traded. Okay, but the rate differential is usually going to be about 0.5 point or so between the two. The underwriting guidelines, you're normally going to be stuck with that 43 to 45% back-end ratio on a jumbo loan. Okay, so they're a little tougher from that perspective, but again, it's the market. But most lenders' jumbo loan programs are very similar to one another. Okay, any other questions on that? All right, good. So CalHFA, California Housing Finance Agency, their down payment assistance and closing cost programs. Next slide. Okay, so I'm going to just really skim through this, but bottom line is this. CalHFA has it set up to where you can do an FHA, a VA, and a conventional first mortgage under CalHFA, and CalHFA will turn right around and loan you the money for the down payment. So for example, on an FHA loan, all right, CalHFA, you'll do a CalHFA first for 96.5% loan to value. CalHFA will loan you or give you a 3.5% down payment second, okay? And they'll turn around and do a third mortgage to help out with your closing costs. So at the end of the day, with CalHAPA, you can end up with anywhere between 102 and 105% loan to value loan on your purchase. Now, some of the rules: you have to be a first-time home buyer, has to be owner occupied, your credit score has to be, I think, can be no lower than like 640, okay? And they're combined with FHA, they're combined with conventional, and they're combined with VA. Now remember, VA is 100% financing. So typically, if you're going to combine a CalHAPA loan with a VA loan, it's for closing cost assistance. All right. Typically, those loans, none of the second or third are going to have a repayment in it. I mean, the houses, they're paid off when you sell the house or refinance out of the loan, but you will not have a monthly payment for the second or the third mortgage through CalHAPA. Next slide, please. Again, a lot of this data we've already covered. First-time home buyer, minimum credit score if it's FHA is 640, minimum credit score if it's conventional is 660. That bullet item where it says DU approval required, that means we have to run the loan through the Fannie Mae, Freddie Mac automated underwriting system, whether it's a conventional, a VA, or an FHA loan, and we have to have it has to end up being graded out as approved eligible, which means it works, it's sellable to the program, okay? If your credit score is 700 and above, you can go as high as 50% on the CalHAPA programs. If your credit score is below that, your maximum debt to income ratio is 45%. Property types: single families, ADUs, condos, even manufactured homes. In terms of eligible borrowers, U.S. citizens or permanent residents, okay, and EAD and DACA borrowers as well. All right. The big one in here is you must be a first-time home buyer. But remember, a first-time home buyer is not just this is your first home. It's also if you haven't owned a home in the last 3 years. Okay. Next slide, please. All right, so this kind of talks about, again, the down payment options. So you'll have the standard, 3% or 3.5% if you're doing a conventional or FHA. You'll also have what's called the third mortgage, what they call their ZIP, which is the closing costs. All right, and the closing costs, basically, they will finance up to 2% of the purchase price of the house to assist you in a closing. All right. Now, they're very, very income driven. You cannot exceed your county income limits for a CalHAPA program. But however, look at this box. In LA County, okay, it's 180,000. Well, most low to moderate programs, they'll go low to moderate by your area code, and they'll only go maybe 140 to 100% or 160% of that area modified or moderate income calculation. CalHAPA will go to the county limit. So the county limit in LA is 180 grand. In Orange County, good grief, look at it, it's $235,000. Okay, and in Riverside, as well as San Bernardino, the income limit is 173,000. So I'm putting this up there to say, don't be confused with some of the other types of down payment or low to moderate income programs you hear about, where they'll take your area income and only do a percentage of it. For the CalHAPA programs, the big benefit is they'll go full boat. They'll go to the full boat of your county income limits, okay? As we talked about before, the second and third mortgages are silent, which means there's no payment on them. And typically they're only paid off when the ownership is transferred. So you sold the home or you're refinancing the first mortgage because of the rates. But think about it for a second. Although you may pay a premium for that first mortgage, you're not going to make a payment on the second. You're not going to make a payment on the third. Okay. So the only time you would be refinancing would say that there's enough equity that is built up in your home and rates have come down low enough to where economically it makes sense to do a refinance. All right. Next slide, please. All right. Basically, these programs are forgivable after 4 or 5 years, after 5 years or so in the home. Again, unless you've transferred interest or done a refinance. Next slide. They're processed like any other loan. That's probably the biggest takeaway from this slide is, it's all 3 loans. If you're doing the first, second, and third, I as a lender, we do all 3. the lender that we end up selling the loan to, they'll check off on all three. So unlike some of the programs where you may have 2 or 3 other entities involved in the loan process, it's just one entity involved in the process. So it's one shop stopping. Excuse me. Next slide. Okay. Ordinarily, we can open up for questions now, or if we want to go ahead and wait for the HUD presentation and then have a question and answer period. One correction, I'm actually with Homeland Financial Network. It's a small broker-owned shop in Orange County. We're what's called a non-delegated underwriter or non-delegated lender. What that means is basically we're not a broker. We don't go through the middleman. We fund all of our loans on our own account, but we target who our investors are going to be, and our investor lenders do the actual underwriting. So we don't have buyback risk in the event that fraud or the event that a loan is foreclosed upon. But the loan is funded in our name, and most all of the loans are funded using our warehouse lines of credit. So Al Perry, I'm the sales manager. There's all of my contact information up there. And you can also reach out to me directly if you want to have a conversation off this call. Thank you. Appreciate it.
Alan, if you will, can you type that into the chat
Yes,
so that
absolutely.
we do have our attendees can save the chat, and that way it's stored electronically.
I will do that right now. Thank you, everyone. I appreciate your time.
I do wish that program had been around before, because I have a CPA background, and I am very, what's the word I should use, comprehensive in my deductions. Right. And so you want to get your income as low as you can because you want to pay less taxes. But then they were using that very low income as the income. They weren't looking at the gross.
But you know what, Gregory? Here's the challenge with that. These programs are not new, but we don't get told about them. Okay, I mean, I hate to say it that way, but bank statement loans have been around for many years. Now, the profit and loss statement, that product came out last year. All right, but bank statement loans have been around a lot of time. But you know, we're so used to walking into Wells Fargo, Bank of America, or Chase, and they may not have those programs, and they're not going to tell you about them. Or if they have them, the loan officer may not be well versed enough in his product line, and he's not going to share it with you. So, you know, that's kind of a plug for doing business with independent mortgage folks.
There you go.
We tend to have a lot more breadth and depth and a lot more products available.
Yep.
Henry, I think you had a question.
Yeah, that's what I wanted to know. What's the difference between walking into Wells Fargo or using a mortgage broker? What are the advantages coming to you?
The advantage is a lot of times you're going to have more products available when you deal with a mortgage broker, okay, or banker. And there's really no difference, not much technical difference between a broker and a banker, but it's really, and also the big thing is product knowledge. Okay. And our world's a little different. Is, you know, that loan officer at Chase or B of A or Wells, you know, they're expected to do many, many loans a month. And it's kind of like if they run across a loan that might take a little more hard work, or they might have to dig a little deeper, they may not have the capacity or the time to do that, or they may not have the underwriters, you know, that have the leeway to approve those types of loans. So what you'll find out what happens so often with the larger banks, you know, they'll solve a lot of their CRA related issues by just writing checks to foundations and organizations and being there to support financially, okay, because that's a lot cheaper for them than to kind of take a look at how they're originating product. Okay. And believe me, I'm a fan of bankers. I don't mean to throw anyone under the bus, but really it boils down to that. It's like one of my friends at Chase told me, you know, is it paycheck or project? Okay. Which means, do I spend 30, 60 days trying to figure out how to make the loan work? Or do I just go ahead and go along with the denial and move to the next one so I can get paid?
That's what they do. They get paid. Thanks.
You're welcome. Thank you.
And we have Teresa up next.
Teresa there?
There she is. She thought out. There you go.
Okay, there we go.
All right, well, thank you so much for having me. My name is Teresa Muley. I'm with HUD. And earlier my computer froze, and I think it was because I had my video on. So I'm actually going to stop the video and I'm going to share my screen and show the presentation. So let me go ahead and do that. And let me know if you can. Where's that? Okay, so hopefully you can see that.
Yeah.
Perfect. Okay, so my name is Teresa Muley. I'm with HUD, and I'm with the Office of Fair Housing and Equal Opportunity. And we're going to talk about the Fair Housing Act today. So the HUD's Fair Housing and Equal Opportunity Office enforces the Federal Fair Housing Act, which prohibits discrimination in housing. The Fair Housing Act became law in 1968, 1 week after the assassination of Reverend Dr. Martin Luther King Jr. And Dr. King was instrumental in getting the Fair Housing Act passed. Dr. King saw a federal fair housing law as imperative in moving the nation forward in addressing racial equality, because there was pervasive housing discrimination based on race and hyper-segregation in American cities. And since that time, the Fair Housing Act was strengthened to give the Office of Fair Housing and Equal Opportunity an enforcement ability. So what that office does is investigates claims of housing discrimination. So it is our job to look at the evidence, interview the parties and witnesses after a complaint has been filed with our office, find out what happened, and then the office will make a determination. And if there is evidence to support a finding of a violation of the Fair Housing Act, HUD's Office of General Counsel can charge the case, and the Department of Justice can bring a federal lawsuit against the people who discriminated against the person who filed the complaint. So it's important for members of the community to know their fair housing rights and where to turn if they experience housing discrimination. So please spread the word that HUD is a resource for community members who have experienced discrimination in housing. So who does the act apply to? It applies to sellers of real estate agents, lenders, insurance companies, homeowners associations, and management companies. The Fair Housing Act has 7 prohibited bases that it covers, and that is race, religion, color, national origin, sex, which includes sexual orientation and gender identity, and familial status, which includes children under the age of 18, pregnant people, people who are in the process of adoption and obtaining custody, as well as disability. So it also covers not only the person who falls under that one of those protected classes, but also people who are associated with that person. It also applies to people who are perceived to be a member of one of those protected classes. So what's prohibited? The refusal to rent, sell, deal, or otherwise make unavailable. Having different terms and conditions in the tenancy or sale of a property. Denial of a reasonable accommodation or modification for a person with a disability. Making discriminatory statements. Retaliating, coercion, intimidation, interference for exercising a right protected under the Fair Housing Act, and discrimination in terms of mortgage lending, appraisals, and property insurance. So just to give you an idea, a reasonable accommodation is a change, exception, or adjustment to a rule, policy, practice, or service. And the Fair Housing Act makes it unlawful to refuse to make a reasonable accommodation for a person with a disability when such an accommodation may be necessary for them to enjoy and use the dwelling in the public and common areas. Excuse me. Some examples of these types of prohibited actions include the refusal to sell, where a seller just refuses to sell to a buyer because of their protected class. Steering, where a real estate agent or a landlord or a management company steers people to a certain neighborhood or a certain building based on their protected class, such as race or national origin or some other protected class. Imposing different current terms and conditions, such as a lender calculating income in a beneficial way for someone who's on workers' compensation leave, but not the same way for someone who is on parental leave, because parents would be protected under familial status, and women who are pregnant or on maternity leave would be protected under category of sex. Or a lender charging a higher interest rate or refusing to lend because of the racial demographics of a neighborhood. Also covered is retaliation. An example of this would be an HOA imposing a fine because an owner complained to HUD that an HOA policy was discriminatory. So talking about familial status, again, that's having a child under the age of 18 or a person who is pregnant. Here's an example that an HOA or management company cannot make overly restrictive rules regarding children's play or the use of amenities. And they can't punish families with children when the children make a reasonable amount of noise, because kids make noise and when they play, and that's to be expected. Neighbor harassment is something that comes up frequently. If a housing service provider is on notice that a neighbor is being harassed due to their protected class, that housing provider has an obligation to address that. And so they should, at a minimum, conduct an investigation, and whatever action is taken depends on the nature and the extent of the harassment and the outcome of the investigation. That especially includes sexual harassment. Domestic violence. HUD recently received enforcement power under VAWA, Violence Against Women Act. And so we are taking in a whole group of cases that are being filed under that law. And so domestic violence is also, actions taken by a housing provider against a person who is a victim of domestic violence can also be covered under the Fair Housing Act under the category of sex, because women tend to be survivors of domestic violence more often, but also actually men are covered as well. And so an example of that is if a HOA issues a violation notice because there's a disturbance at a property that maybe 911 was called, or the police came out because a neighbor complained, but it was due to domestic violence. The survivor has has protections under both VAWA and under the Fair Housing Act. So disability is another protected class. I had mentioned earlier that a reasonable accommodation, a reasonable modification are both things that a person with a disability can request if it's needed, and if it is established that it is needed due to disability, generally the housing provider needs to grant that. And it's a very complex area, so we don't have time to go in depth in that. And if anybody has any follow-up questions, they can certainly ask. But I also have some skill building exercises I'm going to skip over. I want to get directly to the resources that people can refer to. So HUD has guidance and rules. So you can certainly refer to that. There is on the HUD.gov website, there's also information regarding the Violence Against Women Act. And also there are resources for people with disabilities. There's a joint statement that was issued by HUD and the Department of Justice regarding reasonable accommodations, and it's very informative. There's another joint statement regarding reasonable modifications, a modification being a change to a structure, a physical change. And so I think that is all I have for now. I'm going to stop sharing. I apologize. Are you still seeing my screen?
Yes, we are.
Okay, let me,
You did it.
yay. Okay, great. So if there are any questions, I'm more than happy to answer those.
I think
And I also
Robin,
want,
I'm sorry,
oh,
go ahead, Teresa.
I just want to say, and Mr. Perry had mentioned that HUD is a great source for FHA loans. And so I would recommend that anybody who wants to follow up with that, go to the HUD.gov website. And there's just a huge amount of information regarding buying a home and everything you would need to know. So I recommend that you go to that website.
Okay, thank you very much. Robin, you had your hand up. Hello, Miss Robin. Are you still there, Robin? Okay. Well, while Robin is taking her hand up, I have a question, and it kind of falls into what Teresa was talking about, far as HUD and the discrimination. So the CalHalpa was that program, the Dream for All. Was that part of that program, Alan?
Yes, it was.
That one where they ran out of money.
That 5-day program.
That 5-day program. So it is my understanding that program was supposed to be for to close that racial gap.
You don't want to ask my opinion on that, I don't think.
Well, I'm asking this question because it's because I actually met someone that I was on a webinar with yesterday, and she actually applied for that program, was accepted in that program, and then eventually had to come out of that program because her rate was not locked in, and a number of people, and there were a number of people that lost money on their down payment. But that program did not go to the people that it was actually set up for, right? The majority of the people did not get that money. It was predominantly white people that got that program, right?
Is that a question for Teresa?
Surprise, surprise, surprise.
I don't know who wants to answer that question. Who wants to jump in there and ask that question?
I think all Powell just did.
I think I'm not sure who the program was targeted for necessarily, but I do believe that part of the mission of CalHalpa is to, make housing available for more people.
Okay.
I think the problem is, like, for example, one of the realtors I was working with told me about the program, where the account executive for the lender that we work with that has that program, she didn't tell me about it because they were supposedly not to open that program up until March 27th. Okay. But about 4 or 5 days before that, one of my realtors said, "Hey, well, do you have this program? This is something one of my lenders sent me." And when I went back to my lender and said, "Well, you haven't told us anything about this," and she said, "Yeah, because we're not supposed to." So I think what probably happened is word leaked out, because some lenders honored, the CalHalpa's request to not announce it until then, and others didn't. And therefore, I think some folks got a head start on getting prepared for it while others didn't. I would hope that it's going to serve as a training ground, and perhaps they'll bring a similar program back, because again, that literally, I don't think that money was available more than 5 days.
Yeah, I think there's and
my broker actually closed one. The guy who owns our company, I think they actually did one, and you're right. It 99.9% sure it wasn't a person of color, nor, obviously it fit the income, because you have to fit the income limits. Okay, but so often we're not on the front lines in terms of getting this knowledge.
Well, I think I heard about it, and most of us felt that it was too good to be true. And generally we feel that when something seems to be too good to be true, we're so skeptical that it's not going to happen for us anyway, that we are very hesitant. And then of course, then something like this happens. So, and from what my understanding is, it did not, from a person that actually applied for it, it did not turn out to be favorable for those that it was, I guess, originally designed for. Robin, are you back? Did you have your question?
Yes, I'm back. Hi, family.
Hey, family.
I'm over here chomping at the bit because Alan, oh my goodness.
Uh-oh.
Alan, you are the man. I love a person who is transparent, who helps people understand what their options are. I have a journalism degree. I fell into banking over 30 something years ago. And my mission in life was to allow people to understand what their options are.
Right.
You knocked it out the park.
Thank you
You
very
knocked
much.
it out the
I
park.
appreciate those comments, Robin. I really do.
And the other thing that I want to say to our community is, yes, there's sometimes, well, I'll put it this way. We even if we're not, as Crystal will say, even if we're not at the table, that don't mean we can't read, right? And what you provided is the framework that people need to plug into. And when people say, well, why would I go to a bank? Well, the banking has changed. It has totally changed. That's why you need a person like an Alan Perry to guide you through the process. That's what NHS is for, Neighborhood Housing Services, Lori Gay. That's why these independent folks have the time to study and understand what the regulations are, what the programs are, and can bring those options to you based on where you stand financially. And so, Alan, thank you so much for being who you are and how you represent. And please make sure I have your contact information, because I get a lot of requests, and you get nervous about who you refer people to, but I'm quite comfortable with your 15-20 minute presentation that you demand.
Thank you. Thank you. Thank you again. Thank you very much.
Awesome. Quick question. Armand said, what is the maximum income level for the CalHalfa? I know it varies based upon the number of occupants.
Well, for CalHalfa, it's county based. So for example, Los Angeles County is 180. Okay. And Orange County is 235. San Bernardino and Riverside, for example, is 173. But if you go to CalHalfa's website, okay, and you go to the income limits page, it will break down every county in the state.
Okay, thank you. Yasiva says, are there restrictions on the type of properties that can be purchased on the FHA loans if loans is used?
I will take a stab at that, and Teresa's on the line also, but typically obviously 1 to 4 condos. The thing about on FHA, if you're buying into a homeowners association, whether it's a townhome or a condo, usually you're going to want to make sure that the project is approved, that the HOA is approved by FHA. Okay. If the HOA or the development is not approved by FHA, we can in some cases get what's called a spot approval. Okay, which means we would look for that particular project. On every type of condo or townhome loan, you're going to have an HOA questionnaire that's going to get filled out, and there's also an HOA package where you collect the questionnaire, you collect the package, we send it to the underwriter. They'll have their HOA team take a look at it and make sure that it still passes their standards. And as long as it's not on the no list, the rejection list for Fannie, Freddie, or FHA, you normally can get a spot approval. They're typically looking for things like, are there any pending litigation? Is the budget up to speed in terms of enough reserves? Okay, let's see, pending litigation. Oh, also the ratio of owner-occupied homes versus homes that are investment properties. So you got to be very careful if you're in a resort type of community, because a lot of times, those condos or townhomes can be second homes for folks. So, or just flat out investment properties. So, one of the questionnaire questions is always going to be, what's the ratio or percentage of owners that live in the property, on the property versus investors? So you can get spot approvals, but one of the checks you want to do is to see if it's FHA approved. But yeah, you can do FHA on condos and townhomes, manufactured homes all day long.
Awesome, awesome. Thank you, God. Thank you, Alan. You have been incredible. As Ms. Robbins says, you gave us all the 411. We do appreciate you. This is what the community briefing is about, getting that real information, guys, so that you can then take that information and work with it. So we can make sure that we get that right, so we can make the right decisions for ourselves. And hopefully it's firsthand information. So reach out to him if you're looking to buy a home. I know in California and Los Angeles is a little, wow, the cost is a little prohibitive these days, but maybe there's somewhere in this state that you can buy a home somewhere. So thank you, Alan. We so appreciate it. Next week, guys, our guest is Miss Tia Delaney Stewart. She is the director of the Alzheimer Association of California Southland. A lot of us have parents that are and we are caregivers of our parents that are been afflicted with Alzheimer or dementia. So you definitely tune in. This month is May, and it's Mother's Day month, and we're caring for our loved ones. So definitely come back next week. Actually, and also on May 18th, I put it in the chat. We are having a symposium on the Crenshaw corridor. It's going to symposium. It is both a live and it is actually our weekly a community business briefing or a briefing meeting. So, but it is going to be in person and live for those. This is a small facility, so we don't have room for everyone, but you still will be able to be with us on our Zoom call. So we want you to go use that link. It's not the same link that you use for our weekly meetings. It's a special link. So sign up for that. You can actually be tapped in. We're doing remote. We're getting a little sophisticated.
Oh, yeah.
We're gonna have a remote team. So
Crystal, is that why there's no address on there? Because you don't want us to come?
That's correct. Yes.
But there are some that is getting a VIP invitation. But yeah, that's
essentially the live is intended for those businesses who are on the Crenshaw corridor. So the symposium is about the Crenshaw corridor and doing business there. So I hear my New York accent saying quarter. So if you are a business on the Crenshaw corridor there, then we'd like you to have certainly register and see if you can attend. For the rest of you guys will be checking us out on Zoom as you are now today, and that is going to be on May 18th. And a lot of this was put together by our Michael Anderson, who is president and CEO of Anderson Barker Architects. So next week, we've got Tia Delaney on Alzheimer's, and then Michael Anderson, and also Sarah Harris with the Black Business Association will be joining us on the 18th as well. So,
right.
So we've got a great group.
We do have a great group. Danny Bakewell from the Bakewell company. We have Daryl J. Carter from Havana Capital Management, Jason Foster from Destination Crenshaw, and Sherry Franklin from the Urban Design Center. So you guys want to check it out. And then, of course, Michael Anderson is from Anderson Baker, our architect. So we're going to really talk about the Crenshaw corridor, past, present, and future. We are really working on being more connected on what's going on in our community. We don't have say-so. We can't talk about gentrification if we don't know what's going on. And if we don't have say-so and we don't stand up and voice our opinions, we can't do it from the outside. We got to do it from the inside. We got to be sitting at the table having these discussions. So we want to thank you guys for coming here every week, and go tell everybody this is the place to be to find out what's going on. We
Go
do
tell
thank
it on
you
the
guys.
mountain. Go
Go tell it on the mountain. And as Greg would say, let the force be with you. Go ahead, Greg.
May the fourth be with you.
So, go over to our YouTube channel, hit that subscribe button so you get you get a notification every time. Subscribe for May 18th. It's going to be phenomenal conversation that we're going to have. This is going to be this is our first symposium. We will have others in other areas that pertain to our community. So thank you guys so much for joining us. Thank you, Alan, for bringing such a wealth of it. You guys find this information informational for you? We had Joseph, he was awesome a week ago. We had Deborah, she was awesome. You guys are just bringing it to us. Kevin, you were in that home American dream. Was this good for you?
Oh, sorry about that. Yes, it was very much so.
Well, good. You come on back, bring some friends. This is the place to be at 11 o'clock every Thursday. We are here. So thank you guys all for being here. Roz, all of you, Monica, you've been following me all week long, man. I have been doing workshops after workshops after workshops all over this city. I got another one tonight on cash flow with Vermont Slauson. So if you guys want to check that out, I'm doing cash flow. Yesterday, I think I did QuickBooks in the morning. I did, let's see, Yeshiva was with us. We had a great conversation on working on your business, not in your business. And then last night I did one on the risk management and bookkeeping compliance. So we are all about learning how to work on our business, not in our business. So cool. Thank you guys. Yolanda, how was your math symposium last week?
It was absolutely amazing. I got presented with a $15,000 check from the Finnish government for my work. So yeah, it was just great. So thank you for those of you who came out and supported me. My next summit will be all about Black children and reading. So look out for that flyer. Just about to hit your emails, your Facebook pages, and your social content.
All right. So Yolanda's making
for tennis.
Okay, we'll see you on Saturday. Yolanda's making sure our children can read and are going to be mathematicians. So y'all support her.
Yes. Thank you.
All righty. So thank you guys. We're going to sign off. We do appreciate you. We'll see you again. Again, Mr. Allen, Ms. Teresa, thank you guys so much. We will see you guys. Henry, thank you for coming out. That's my business and my tennis friend over there. And Kevin, come back. And Mr. Armand, that's my bud over there. So we will see you guys. Thank you all for coming out to visit us once again. And make sure you go over and sign up for this symposium.
And subscribe to our channel.
Yeah. Love you guys.
Thank you.
Thank you.
All right. Bye.
All right.